Hi everybody, Shah here, news editor from Hotel News Now with Shah, CEO of Noble Investment Group. And we've just got to the end of kind of a dreary looking Q2 earnings season. A lot of people scaling back their expectations for the year and wondering whether things are kind of getting a bit flatter in terms of RevPAR in the hotel industry. Just from your perspective in Noble, how are things looking? Good, bad, indifferent? What's your outlook on the industry?
You know, this second quarter actually set up in a way where the July 4th holiday, we kind of knew that it was going to be in the middle of the week. And so for, all the data, we knew that week was going to be bouncy, depending on the markets. What I don't think most people expected was how the rest of the month was going to shape up in terms of, really just the third and fourth week. August kind of looks to be much the same. And now we know that, we've got some holidays moving into the month of September, and so you've got really three things in the month of September that are going to create a little bit of a different environment between Labor Day and the two holidays. And so third quarter is going to look a lot like second quarter, and I think for most people they were looking for what's the sign, and everybody, it's all the analogies and all the questions that people have about this feels like it's been way too good for way too long. Somebody please give me a sign that, hey, it's going to, be good for a little bit longer, or let me not be the last one to turn off the lights when demand looks like it's going to go turn negative. And so I don't know that second quarter is the right way in which to look at it, just given some of the dynamics that happened in the month of July. But it is important to pay attention to the data. If you look at other data sources like Travel Click and the like, they're showing a very robust October, and they're showing the fourth quarter actually bookings on the group side very good, and also into next year. We've been to this movie before. We've seen what's happened kind of in that second quarter that gives investors and gives people in general pause about what's happening in the overall industry, and then we've seen kind of the fourth quarter shape up in a much different way to give people a little bit more reassurances. I don't know exactly how it's going to pan out. I think our fundamental philosophy at Noble remains the same. We think it's micro over macro, and the macro lodging fundamentals we believe continue to remain very, very strong, but it's 2 to 3% RevPAR growth, and that's certainly not what it has been over many years in the past, but it's still good relative to other industry classes. And absent macroeconomic shocks or geopolitical shocks, which we all know have happened over many cycles, and so over the 24 years that Noble's been in business, we generally believe that the upscale lodging segment, which we participate in, has remained the most stable. Actually, there's a very interesting data point. Now, we're at a data conference. So if you take the 30-year data on the upscale lodging segment, which includes more than select service extended stay, as we know, but if you look at that from 1988 to 2017 and look at every 10-year period on average, every single 10-year period has averaged over 2% RevPAR growth, with the exception of one period, and that was 2000, dot-com bust, and 2009, the height of the Great Recession. And that was even positive. That was 0.4%. So if you look at it kind of on those long-term averages, we still believe that the health of the upscale lodging sector remains very good. Transient demand, while not as exciting as it perhaps has been over the last couple of years, remains at least stable enough that we feel that 2 to 3% RevPAR growth in the micro markets that we're focused on is achievable, barring these unforeseen macroeconomic shocks.
So where are the opportunities going forward for Noble? What are the white spaces for you, and what do you think is really poised to take off? Well,
at every period of time, it's a little bit differently. Sometimes there's opportunities for development, sometimes there are opportunities based on CapEx needs of assets and illiquidity, redevelopment, repositioning. So that'll still be a core of our business. We've opened up hotels in major urban centers where retailers have repurposed existing land, and we've been able to build hotels, and for lack of a better example, Nordstrom's parking lot, which has been very good. There's fewer of those in today's market cycle. We do actually see opportunities to buy select service extended stay hotels at very attractive going in yields. And so I'll just use that same example. If you just think about a 2% RevPAR growth growth over the next 10 years, and you leverage something at a 7 to 8% cap rate, at 50%, at a 5% interest rate, you still are paying out a very healthy dividend. And you can actually take a 10% hit to RevPAR and still make a very consistent kind of income out of that. So that remains the core of our business. We actually believe that in this market cycle, there's going to be more opportunities in which to buy that existing yield, and that's what we're going to be focused on.
Yeah, did the capital markets influence that at all? I know they favor existing assets over new builds at this point. Is that way into your thinking?
Well, there's public capital markets and there's private capital markets, and so to answer the question in two different ways, on the public capital markets, they're generally not redevelopment, repositioning. They're looking at where can we get consistency of income and durability of cash flows and a dividend that makes sense, and that's kind of how those investors look at it. On the private side, there are two different ways. On the value side, it's hey, let me go buy, fix, and sell, make a 2 multiple and 20 IRR, or develop and create a durable income stream. But then on the buy side, on just the income side, we're introducing an income platform this year where for really the first time in the private space, a dedicated private vehicle to go buy income producing assets in the select service extended stay category. And the thesis is again very simple. If you can buy at a 7 to 8% cap rate on existing cash flows, then you can really provide at even at 50% leverage a very good income stream to state pension plans and university endowments, which are the crux of our LPs.
So it seems like you hold a lot of reasons for optimism. Is there anything on the horizon that worries you?
I think I continue to believe that if you're in this business, you have to be optimistic. And but the reality is that we know what derails the growth and the momentum, and it's always been an outside event. It's been something that's been created that has created a shock to the environment. And I think what you have to do is you have to recognize that there's still multiple ways that our economy can get shocked. We've just seen here more recently geopolitical concerns and what that's done to the overall marketplace. So those things you have to keep in mind. We've been there before. It'll happen again. Every time has been very different. The thing that I believe that's very strong about this subsect of the lodging industry, which is what we've made our business around, is really just the consistency of those income streams. And even when they've been shocked, the ability, because of the low fixed cost, to be able to continue to deliver income streams.
Well, thanks so much for your time, Matt.
Sean, it's been a pleasure. Thanks.
Stay tuned to Hotel News Now for more from the Hotel Data Conference.